Mixed signals has been the phrase of choice for the past few years when it comes to the private equity-backed middle market transactions that GF Data tracks. Today, GF Data's Bob Dunn and Forvis Mazars' Scott Linch are back with us to reflect on the final numbers from 2025 and what they predict that could mean for the year ahead. Bob, let's jump right in. What are the headline numbers for middle market M&A from Q4 2025 and from the year in total?
Yeah, Carolyn, thanks a lot for having me. I think we talked about choppy waters here. That's definitely what we saw in 2025 in terms of private equity-backed middle market M&A. Number of factors at play. Ultimately, when we look at the full year, we saw consistency in valuation at 7.2 times trailing 12-month EBITDA, and that's been the case for 2025, 2024, and 2023. But as I said multiple times, that consistent multiple masks a lot of underlying activity and fluctuation on it. The big note on it was if you look at deal volume in 2025, we saw a 23% drop in deals tracked by GF Data compared to 2024, which was a bumper year as the second highest total we'd seen since 2021. But right now with 2025, we're right back to where we were in 2023. So sort of a return on it. Interestingly, we saw a lot of fluctuation quarter to quarter in terms of valuations, and generally it was in lockstep. When we saw deal volume increase in the quarter, we saw valuations drop. That was the case in the fourth quarter. Tracked 80 deals, decent increase over third quarter, still below where we want to see, but we saw a valuation slip down to 6.9 times trailing 12-month EBITDA versus 7.5 in the third quarter. So I think that choppiness that we're seeing is due to a number of factors. There's obviously a lot going on in the world, a lot going on in the U.S. right now. I think a lot of policy questions, and it's really just been kind of, I think, one surprise after another for the market, and that's made consistency be really challenging on it. But one interesting factor we did see in the fourth quarter is the number of add-ons as a percentage of total transactions started to drop in the fourth quarter. It's down to 31%, which is right around the historical average outside of the last 2 years, where we saw that number or percentage rather creep up to 40% of the total deals tracked. To me, that looks like a market that's coming back to normalcy, even though the deal volume isn't there. So positive sign going into 2026. But, again, the momentum is just not where we expected to be and what Scott and I talked about back at the beginning of 2025 and what we thought we'd see for the year.
Scott, anything to add there?
Yeah, I mean, it has been a strange year, as we keep saying. The first half of the year, with the election, I think that it did have a slowdown. And so we saw, even, I know the numbers kind of show this as well, but we saw a pretty slow first half of the year with some increase in the back half. And it's interesting, we had a 23% decline in deal volume in the GF Data information, but the multiples were able to stay as high as they were. And I think it's because people are just being more selective, and they're looking for these A-plus assets, and they're able to find those and still pay for them. And then there's some larger deals that got done that helped probably those numbers as well. But, we are seeing the second half of the year, it started picking up because people got through the noise, is what we always say, is there was a lot of noise. They got through it. We'll talk a little bit later about the new noise. But I do think investors have started to learn how to deal with the fact that there's something new on a regular basis. And they are putting more equity in their deals too, which we saw on the debt information that Bob had. That putting more equity to work is something they're having to do on these deals because they aren't finding as many deals. So you have to put your assets to work somehow. And so we are seeing that. Our report that we released, our survey we released the first half of the year, showed some of these same trends, and just the hold periods that we're seeing are continuing to extend because there are these challenging times and unloading these assets, and in these times has been a little harder.
We're speaking today just as April kicks off, so Q1 has wrapped, but the numbers are still rolling in. Scott, I want to talk to you about what you've seen on the ground in Q1. What is some of that new noise that you just talked about?
Well, we got off to a great start. I feel like there's a lot of deals ready to ramp up and go into market. I still feel that way. I still feel that we're seeing people getting assets ready. We are seeing increased pitch activity at our investment bank. We're seeing higher activity in our diligence practice, and that's really fourth quarter and into the first quarter that has continued. A lot of that is sell-side due diligence, so we're seeing that piece pick up. But then we got thrown a curveball here with the war in Iran. I think that is it's doing a couple things. It's probably making interest rates where it's going to be hard to do anything about that anytime soon. It's not helping our inflation situation. Some of the things that we saw happen at the beginning of last year is sort of revamping some of those same issues. So I think, it's going to reshape like how we think about pricing structure, timing of deals. And so we'll see some definitely increased diligence around some of these areas. And, any business that it's driven by energy prices or things like that, or, businesses that rely heavily on oil and gas. I mean, you're going to see potentially some different diligence done around those businesses as we approach a transaction. So it's definitely thrown a curveball on us, and we still think that people are going to work through it, and hopefully it'll be over sooner than later, and people can continue to move on with the deals that they were about to take to market. They'll hit the market, and we'll see some good exits.
Bob, anything to add there?
Yeah, I'd like to loop back around because I thought Scott started off, and I agree with all of his comments. But it does seem like, and what we've seen in the data is that there is a larger component of equity going, particularly into platform deals currently. For 2025, we tracked 57% composition of equity. That includes sponsor equity as well as rollover equity. But that's the highest total we've ever tracked on it. And the opposite end of that, senior debt was down to just 31% of composition within platform deals. So it does seem like there's concern, well, a few factors on it, but one, private equity wanting to put more capital to work, and also potentially putting a bigger cushion in there, not taking on as much debt, just to keep a little more flexibility on it. And I guess also we're looking at platforms, having the additional equity there can be a bonus as you're adding companies to the platform on it. But it was a little bit of a surprise on it. It does seem to be I think the debt's available, the pricing is lower on it, but it seems like it's the sponsors that are keeping the equity higher and the debt lower on it, which to me says a bit of caution in the environment, or prudence maybe is the best way to put it.
Prudence. Okay, fair enough. So there are a lot of macroeconomic and geopolitical factors at play right now. So looking to the year ahead, can you tell me some of your predictions for the remainder of 2026? Bob, let's start with you.
Yeah, I mean, we sort of talked about this in the reports when it came out. I think 2026 will be an improved year over 2025. Now, I expected 2025 to be a banner year for, a lot of the reasons there. You have the silver tsunami concept going on. You've had delays in exits, both from private equity firm, and I think when debt pricing was higher from the sell side as well, looking for kind of calmer seas on it. A lot of that materialized last year, but we didn't see the bonanza of deals on it. I think the market will steadily improve in terms of volume. I think as that volume improves, you probably will see some adjustments to pricing going on. But I don't see it from 2026 as being a boom per se, as more of sort of steady growth throughout the quarters on it.
All right, Scott, can you close this out? Anything to add there?
Yeah, I mean, I've said this before, but I think when you look at private equity sponsors today compared to 18 months ago, they are talking more and more about, we just sold a portfolio company, or we're about to sell one. Or we're about to buy one, and the conversations around that have really picked up. And so I think that as these assets trade, we'll see more platform deals get done this year than last. I do think we'll make our way through the noise that we talked about earlier. There's just so much dry powder out there. While the sponsors are having to be more selective, there should be more deals out there for them to do. And they should, and that's from them trading to each other, but also we deal with a lot of private owners that are getting ready to sell their business. They've made it through the noise that that we talked about last year, and they waited a year. They're ready to go to market now. So we do anticipate deal flow to pick up, which will in turn create more platform deals and more add-ons as they continue to build those as well.
All right, prudence, but also some steadfast optimism from you both. Thank you so much, Bob and Scott. Always a pleasure.
Thanks, Carolyn.
Thank you.